Welcome back to the deep dive. Today, we're doing more than just, our routine due diligence on a quarterly report.
Hmm.
We're really peering directly into the engine room of the American financial system. Our focus is the Wells Fargo and Company. That's WFC fourth quarter 2025 earnings analysis.
And this really is a pivotal moment. It's not just another earnings cycle. Wells Fargo is a systemic banking giant.
Right.
I mean, what that means is its quarterly results are a reflection of so much more than just how the bank is being managed. They really reflect the core health of the American consumer, the stability of commercial lending.
And the trajectory of the whole U.S. economy, really.
Exactly.
What makes this specific quarter so critical, though, is the context. For almost a decade, Wells Fargo has been operating under the shadow of the Federal Reserve's asset cap.
A monumental restriction. It literally stopped them from growing their balance sheet beyond a certain point.
And so this report, it gives us one of the first really clear views of the bank operating without that regulatory constraint.
Right. They're essentially moving from a state of, let's call it enforced remediation, to one of strategic execution.
So that's the core thesis we're investigating here today.
It is. For years, every single strategic decision was colored by compliance and constraint. Now, that structural handcuff is off.
So our mission for this deep dive is what exactly?
Our mission is to synthesize all this dense, raw financial data that management gives us, put it up against what Wall Street was expecting, and then construct a full narrative.
Okay.
We don't want to just explain what figures the bank hit. We want to explain why those figures matter and what they tell us about the bank's future, its ability to actually compete in the marketplace again.
Because let's be honest, staring at a 10K or one of these investor presentations can feel like looking at an impenetrable wall of numbers.
It absolutely can.
So to help you, the curious learner, navigate all that data, we've structured this conversation into 5 clear parts. We're going to move through the immediate scorecard, analyze the engine of profitability, break down performance by business segment, assess the bank's financial strength, and then finally, we'll look at management's roadmap for the future. Now for slide 1, the at-a-glance scorecard.
Right, the scorecard. This is where all the immediate drama lives. These are the headline numbers that hit the wire and, dictate that immediate, often very volatile stock market reaction.
Okay, so let's start at the top line, the core financial performance. Wells Fargo generated total revenue of $21,292 million for Q4 2025. I mean, that's a huge figure, but how does it stack up against last year?
It's incremental progress. That $21.292 billion, you compare it to $20,378 million in Q4 of the prior year.
Okay.
When you run the calculation on that, it translates to a year-over-year revenue growth of approximately 4.5%.
4.5%. In the world of these massive systemic banks, that's healthy.
Yeah.
But it's not setting the world on fire.
No, it's not high-flying. It suggests stability more than, say, aggressive expansion.
All right, let's move down to the bottom line, the actual profit. Net income for common shareholders was reported at $5,361 million for the quarter.
And that's compared to $5,079 million in Q4 of 2024.
It's a little better there.
Little better, yeah. Here we see a slightly better performance. The growth rate for net income came in at about 6.0%.
Okay, so this is where the bank starts converting that steady revenue growth into accelerating profit growth.
Exactly. It's an early sign that their cost controls are starting to pay off.
But the number that really generates the most buzz, especially among retail investors, is diluted earnings per share, or EPS.
Right.
Wells Fargo reported GAAP diluted EPS of $1.62. That's way up from the $1.43 reported last year.
And that EPS figure, that's where the story gets fundamentally interesting. That $1.62 represents a year-over-year growth rate of a remarkable 13%.
13%.
Now, just listen to those numbers again.
Right.
Revenue grew 4.5%, net income grew 6.0%, but EPS grew 13.0%.
That is a massive mechanical divergence.
It is. And understanding how they bridge that gap, that's the key to understanding this entire report.
Okay, before we dive into those mechanics, let's just quickly nail down that term, diluted EPS. I think a lot of listeners might just glaze over the difference between basic and diluted, but it's really crucial, isn't it?
It is, absolutely. We always focus on diluted EPS because it gives you the most stress-tested, prudent view of shareholder value. Basic EPS is just net income divided by the shares that are actually trading right now.
Simple enough.
But diluted EPS, it operates under what's called the if-converted method. It assumes a hypothetical worst case scenario,
Meaning what exactly?
meaning it calculates what would happen if all potential shares, so we're talking executive stock options that haven't been exercised, convertible bonds, warrants, what if they were all suddenly converted into actual common stock?
Ah, so if every executive cashed in their options at once.
Precisely. Those new shares would flood the market, instantly increasing the share count, that's the denominator in the equation, and diluting the value for everyone else.
So diluted EPS gives you the conservative figure, the one that analysts actually trust.
It's the standard. It's the number you have to look at.
Okay, so we have a 13% EPS growth rate. On the surface, that sounds like a clear win. But as you said, Wall Street always adjusts for the noise. What was the big non-recurring event this quarter that needed a non-GAAP adjustment?
The main notable item was a pretty significant $612 million severance expense.
Severance, so layoffs.
Exactly. This was the one-time non-recurring cost tied to their ongoing, very aggressive workforce reductions. It's the price of streamlining an institution of this size. And this expense reduced their reported GAAP EPS by about 75 cents per share.
So to get that clean number, the one that shows the real operational strengths, we just add that back in. So $1.62 GAAP plus the $1.14 severance gives us an adjusted diluted EPS of $1.76.
And that, on $1.76, that's the number that really mattered to the market.
Okay, so now we compare that adjusted number to what the market was expecting, and this is where that paradox you mentioned comes in.
It is. Let's start with revenue. Wells Fargo reported $21.29 billion.
And the consensus estimate, what all the Wall Street analysts were predicting, was $21.64 billion.
Which is a definitive, unarguable revenue miss.
Not by a huge amount, but a miss is a miss.
A miss is a miss. They fell short by about $350 million. In banking, a revenue miss is always scrutinized because it can signal underlying macroeconomic pressure. You know, waning demand for new loans, or maybe pressure on fees.
It's a top-line concern.
It is.
So given that miss, you would think the stock would immediately take a hit. But then you look at the profitability side. Their adjusted EPS of $1.76 was way higher than the consensus of $1.66.
Which is an undeniable earnings beat. They exceeded expectations by 10 cents, or about 6%.
And this contrast is the core narrative of the whole quarter.
That's it. Less money came in than analysts hoped, but management was vastly more efficient at converting every single dollar that came in into profit than anyone anticipated.
All right, now let's look at the market's reaction, which is always the ultimate test. Despite that strong EPS beat, the stock saw immediate, heavy selling pressure right after the release.
It did. It closed at $88.58, which was down sharply from $93.56 the day before. That's a rapid decline of 5.32%.
Ouch. So what does that reaction tell us?
That market reaction is the clearest signal we have of what investors are prioritizing right now. It tells us that, in the short term, the market was far more worried about the revenue shortfall.
And what that implies for future growth.
Then they were impressed by the cost-cutting that drove the EPS beat. Analysts basically said, we love your discipline, but where's the top-line growth now that the asset cap is gone?
That's a critical point. It suggests a fear that maybe the efficiency gains are a one-time thing, or maybe that the macro environment is going to eat away at revenue faster than they can cut costs.
Right.
But let's go back to that phenomenal divergence we talked about.
Yeah.
Why did EPS growth at 13% nearly triple the revenue growth of 4.5%?
Okay, this is where we shift from market sentiment to pure financial mechanics. And that divergence is driven by two of the most powerful levers management can pull. The first one is operating leverage.
Operating leverage. We sometimes call it the widening jaws.
The widening jaws, exactly. It's the ideal scenario where your revenue growth outpaces your expense growth, and that causes the profit margin, the jaws, to widen dramatically.
And Wells Fargo pulled this off perfectly.
Brilliantly. Textbook. Revenue increased 4.5%, but crucially, their non-interest expense actually decreased by 1% year over year.
It went down.
It went down. It fell from $13.9 billion to $13.726 billion. And that 1% reduction isn't trivial. It's the result of strategic, deep, and probably painful cost cuts.
That's really the most important point of the entire quarter, isn't it? That relentless operational discipline.
It absolutely is. And you have to put that 1% expense cut in context. Management has explicitly said they've made $15 billion in gross expense reductions over the past 5 years.
$15 billion. Just think about the sheer magnitude of that effort.
It's huge. They've closed hundreds of branches, modernized countless outdated legacy systems from decades of mergers, and conducted multiple rounds of workforce streamlining.
Right.
And this discipline, which was really forced forced on them during the asset cap years meant that every marginal dollar of new revenue, that 4.5% growth, it just flowed straight through to the bottom line almost entirely unimpeded. That's what fueled that 6% net income surge.
So it's the legacy of constraint now showing up as superior efficiency.
That's the perfect way to put it.
Okay, so if efficiency fueled the net income growth from 4.5% revenue to 6% profit, what supercharged the growth rate from 6% net income all the way to 13% EPS?
And that brings us to the second driver, pure financial engineering, also known as share buybacks.
Ah, the buyback.
It's a mathematical certainty. Since EPS is just net income divided by total shares outstanding, if you aggressively shrink the denominator,
The share count.
you mathematically inflate the final per-share earnings figure. It's just simple math.
And Wells Fargo uses this tool very aggressively.
Staggeringly so. In Q4 alone, they repurchased 58.2 million shares. They injected $5 billion back into the system just to retire those shares.
This isn't just returning capital. It's a strategic manipulation of the share count to boost their EPS performance.
Oh, it is. And the full-year figure is even more compelling as a statement of intent. They returned $18 billion just through repurchases for the full year.
Plus dividends on top of that.
Right. This huge capital return program, it signals two things at once. First, management is confident. They believe their stock is undervalued, so the best return they can get is by buying their own shares.
And second,
It's a commitment to the owners, the remaining shareholders. They're ensuring that those shareholders capture a mathematically larger portion of the bank's profit pie. The aggressive retirement of shares is the single most powerful mechanical reason why EPS growth nearly doubled the net income growth rate.
so the complex story here is a market reacting to the macro risk implied by the revenue miss, while internally, the bank is just dominating what it can control, its costs and its capital structure. And that drove a massive, structurally supported EPS beat.
It really makes that initial 5% stock drop look like a potential overreaction to yesterday's news, doesn't it?
Moving to slide 2, the engine of profitability.
Okay, so we've moved past the headlines and the market noise. Now we can dig into the core ratios that tell us how efficiently the bank is actually running. These ratios tell us whether that recent success is sustainable.
Let's start with the metric that most bank analysts consider the ultimate test of performance: return on average tangible common equity, or ROTCE. Why is this considered the gold standard?
Because it's the cleanest measure of how effectively management is using the real hard cash and capital from shareholders to generate profit. It strips out non-physical or intangible assets.
Things like goodwill from old mergers.
Exactly. Goodwill is the premium you pay over book value during a merger. These intangible assets, they distort the basic return on equity, or ROE. ROTCE gives you a pure, unadulterated view of the operational efficiency of the bank's actual tangible assets.
And what did WFC report for Q4 2025?
They reported an ROTCE of 14.5%. That's a healthy increase from the 13.9% they reported a year prior.
And crucially, management confirmed they hit their full-year target.
They did. That's a promise made and a promise delivered. They said they'd hit 15% for the full year 2025, and they did.
And here's where it gets really interesting for the future.
Yeah.
Because hitting that target wasn't the ceiling, it was the stepping stone.
The signal they sent was resoundingly bullish. Because they proved the sustainability of their efficiency gains, management raised the bar significantly.
What's the new target?
The new medium-term target for ROTCE is now between 17% and 18%. Achieving an 18% ROTCE would put Wells Fargo right up there among the elite of the systemic banks. This upward revision, it's a strong commitment. It suggests the remediation is over, and the focus is now entirely on profit maximization.
And the tangible proof of that profit maximization, that momentum from the cost-cutting, is best seen in the efficiency ratio.
That's right. The efficiency ratio is a simple question. How much does it cost the bank to generate $1 of revenue? A lower number is always better. It means less friction, more leverage.
And Wells Fargo reported a ratio of 64%.
64%.
So for every dollar they make, they spend 64 cents. How does that compare, and what does it tell us about the sustainability of their EPS beat?
That ratio is a massive operational achievement. It is a remarkable improvement from the 68% they reported just a year ago in Q4 2024.
So a 400 basis point drop in a single year.
A 400 basis point improvement. It confirms the power of those cost-cutting initiatives we talked about. It's definitive proof that the expense discipline is creating a structurally leaner, more agile, and ultimately more profitable operating model. That 64% ratio is the justification for management's confidence, and the basis for that raised 17–18% ROTCE target.
Okay, a bank generates its revenue from primarily two distinct methods, the two main cylinders of income. Let's look at how that revenue is being composed.
The first, and historically the most important, is net interest income, or NII.
Right.
This is your traditional banking spread. The difference between the interest the bank earns on its assets, like loans, and the interest it pays out on its liabilities, like deposits.
And NII for Q4 came in at $12,331 million. That's up 4% year over year, which seems pretty good. What's driving that?
The growth was driven by successfully expanding their loan and investment securities portfolio. That's the volume side of the equation. But the primary headwind is something called deposit mix changes.
Which is a crucial concept to understand in a high-rate environment like this.
It is.
You called it cash sorting earlier. Can you elaborate on what's motivating the customer here?
Absolutely. Cash sorting is just rational customer behavior. Customers realize their basic checking or traditional savings account pays almost zero interest. So they are actively managing their idle cash, moving it out of those low-rate products.
And into higher-yielding things like CDs or money market accounts.
Exactly. They're chasing yield, as they should be.
And while that's great for the customer, it significantly increases the cost of doing business for Wells Fargo.
Precisely. That movement raises the bank's overall cost of funds. They have to pay more interest to keep that critical pool of deposits stable. So even though they're growing their loan volume, the margins on those loans get compressed because the cost of the money they're lending out is increasing. It's a natural speed limit on NII growth.
So if NII is constrained by these rate dynamics, the bank needs diversification. And that brings us to the second cylinder, non-interest income.
Fee-based revenue. This is revenue generated independent of the interest rate cycle.
And this was very strong.
Extremely robust. It came in at $8,961 million, growing 5% year over year. And this income is so valuable because it provides stability and it's often a very high-margin business.
So where did that 5% growth come from?
It was overwhelmingly powered by their Wealth and Investment Management, or WIM, division, specifically through higher asset-based fees.
So this is a clear correlation to the external capital markets. The bank's performance here is almost a direct reflection of the S&P 500.
It's a beautifully simple mechanism. As the stock market, the S&P 500 rises, the value of the assets managed by Wells Fargo for its clients also rises automatically.
And since they charge fees as a percentage of those assets?
The bank's fee revenue goes up without them having to acquire a single new client or sell a single new product. It was also supported by some increases in card fees and mortgage banking, but the market correlation in wealth management was the undisputed champion of fee income this quarter.
That structural efficiency, coupled with the benefit from the market, really painted a positive picture for profitability. Now, let's peel back the curtain and see which specific parts of the bank are actually generating this value. Moving to slide 3, the engine room business segment performance.
This deep dive into the 4 major business segments is so important because it reveals a crucial underlying dynamic. The economic recovery in the U.S. is very much K-shaped.
Right.
We need to see which segments are accelerating, the upstroke of the Ks, which are lagging behind on the downstroke.
Let's start with the largest revenue contributor, consumer banking and lending, the retail heart of Wells Fargo. They posted $9,571 million in revenue. That's robust 7% year-over-year growth, which suggests the American consumer is holding up pretty well.
This segment is a testament to the resilience of the U.S. consumer and the success of WFC's retail strategy. Within this, the core consumer and small business banking saw revenue up 9%. And that was driven by higher balances and, critically, their success in maintaining lower deposit pricing.
That is a key detail. If cash sorting is a macro headwind, WFC managed to counter it better in their massive retail base than their competitors. How do they do that?
It often comes down to loyalty and digital engagement. While a savvy investor is moving cash into CDs, a huge portion of the retail consumer base relies on the convenience of their local branch or their digital app. They're just less rate sensitive.
Right.
And WFC successfully leveraged that relationship stability, keeping their retail cost of funds relatively low compared to, say, the wholesale funding market.
We also saw some really strong signals from consumer credit.
Absolutely. Credit card revenue was up 7%, reflecting strong consumer spending and confidence. And the future growth pipeline looks strong, with new credit card account openings surging 20% from a year ago.
20%, that's aggressive market penetration.
It is. It confirms Wells Fargo is actively lending and that the average consumer is willing to take on new debt.
And they saw a genuine turnaround in the auto segment, which had struggled.
Yes, auto revenue grew 7%, which is massive considering all the supply chain volatility we've seen. Management specifically highlighted that this unit has returned to growth, with loan balances jumping a substantial 19%.
So this isn't just maintenance, it's a focused strategic recovery.
It is.
The only major retail headwind was, I think predictably, home lending.
Yeah, home lending revenue declined 6%. And this is not a Wells Fargo problem. It's an industry-wide crisis driven by elevated interest rates.
Right.
High rates mean fewer people are refinancing, and transaction volumes for new purchases are depressed. Mortgage origination is just an extremely difficult business environment right now.
But despite that mortgage drag, the bottom line for consumer banking and lending absolutely exploded.
It did. Net income for CBL skyrocketed 33% to $2,128 million. That is an enormous jump on only 7% revenue growth. This is the clearest, most profound evidence of that positive operating leverage we could ask for.
So the huge cuts they made to the retail branch network are now delivering these disproportionate, jaw-dropping profit margins.
They're extracting far more profit from fewer resources. It's a testament to the strategy.
Okay, now let's shift to the commercial side. This serves medium and large businesses. This segment faced noticeable pressure, reflecting how the high-rate environment is impacting capital expenditures. Revenue was $3,079 million, down 3% year over year.
That 3% decline is a direct result of margin compression in corporate lending. The segment suffered an 11% drop in net interest income.
11%.
Yeah. This was partly due to lower interest rates in this specific portfolio, but also a strategic decision to transfer some lower margin business deposits over to the consumer segment to better optimize costs.
So the underlying question here is this decline a temporary rate thing, or is corporate America just pulling back on borrowing because of macro uncertainty?
That's the question analysts are wrestling with. If companies aren't borrowing for major projects, it puts sustained pressure on this segment. However, they found a critical bright spot for diversification. Their non-interest income jumped 18%.
Where'd that come from?
Largely from niche activities like tax credit equity investments. This proves that while the core lending business is struggling, the fee-generating advisory side is finding new avenues for revenue.
But overall, the pressure on core lending margins meant net income fell 5% to $11,142 million. So the core commercial lending machine is definitely working against some significant headwinds.
It is.
Okay, next up, the bank's dedicated Wall Street arm corporate and investment banking, or CIB. Revenue here was virtually flat.
Yeah, it came in at $4,616 million, down only 0.06% year over year. Basically flat.
Flatness in this segment is often a sign of market stability, but it can mask a complex internal balancing act between investment banking and trading, right?
It certainly does. Investment banking revenue, which is advising on M&A, capital markets, IPOs, that declined 7%. And that reflects the overall sluggishness we've seen industry-wide in large-scale deal-making. Companies are just hesitant to commit to massive transactions right now.
But the CEO commentary added some really crucial context that challenged that negative headline.
Absolutely. The nuance is in the high-margin advisory business. So while total investment banking revenue declined, advisory fees specifically increased a sharp 14%.
14%.
And on top of that, Wells Fargo's M&A ranking improved significantly. They jumped from 12th place to 8th globally.
So even though the overall fee pool is smaller, WFC is gaining market share and excelling in the high-value advisory side of the business.
Exactly.
And the trading desk, how did the markets division perform?
Markets revenue rose 7%, which compensated for that advisory sluggishness. But this was a tale of two markets. The equities trading desk saw strong performance, driven by market volatility and structured product activity.
So that benefited from the overall upward market trend.
It did, but this strength was partially offset by weakness in FICC, that's fixed income, currencies, and commodities, which saw lower activity due to uncertain rate policy and lower trading volume in credit products.
So overall, the CIB segment managed to grow net income 4% to $1,639 million. Even flat revenue, coupled with that expense discipline, can generate bottom-line growth.
That's right.
And finally, the segment that demonstrated the most powerful market-correlated growth, wealth and investment management, WIMM. This caters to affluent and high-net-worth clients.
This was the growth star.
This segment posted the fastest top-line growth of any major division. Revenue was $4,360 million, surging 10% year over year.
This segment is a perfect beneficiary of the current economic climate. Their net interest income, driven by rising rates on client balances, was up 16%, and their non-interest income was up 9%.
And that 9% rise in non-interest income, that's the clear correlation to the S&P 500 we discussed earlier, isn't it?
It's the driving force. The persistent rise in stock market valuations throughout 2025 automatically inflated the value of client assets under Wells Fargo's management. And since their fees are percentage-based, the revenue stream is essentially automated growth. It's a highly reliable, high-margin revenue stream.
The bottom line reflects this leverage and the market tailwind.
Net income for wealth and investment management skyrocketed 29% to $656 million.
So that K-shaped recovery is vividly clear here. WIM and consumer banking are soaring, funded by cost cuts and market gains, while commercial banking and home lending are struggling with margin pressure.
It's a tale of two banks, really.
Moving to slide 4, financial strength and shareholder rewards.
We shift now to assessing the safety and security of the institution, what we call the fortress balance sheet, and confirming its commitment to returning capital to shareholders, which ties right back to that massive EPS growth we saw earlier.
And this section really begins with the structural narrative we opened with, the end of the asset cap. For nearly a decade, WFC was legally restricted from growing its total assets beyond $1.95 trillion.
It's a historically significant constraint, and the Q4 2025 results definitively announce its demise. Average total assets grew to $2.08 trillion. That's an 8% increase year over year.
And that 8% growth, it's not just a financial figure. It is a foundational strategic signal.
It proves the bank is shifting from a defensive constraint management stance to an offensive growth-seeking strategy. They are back in the game.
This is the practical manifestation of that strategic freedom. So let's look at the growth components. Are their core revenue-generating assets expanding?
Yes. Average loans increased 5% to $955.8 billion. And loans are the lifeblood of NII.
Right.
And management commentary specifically highlighted a massive 12% growth in commercial business loans. This shows they are actively deploying that newly freed balance sheet capacity by lending aggressively to commercial clients.
12% growth. That is a huge change from the constrained years.
A night and day difference.
And what about the fuel for that engine deposits? Even with all the cash sorting we discussed, deposits need to be stable for this to work.
They are. Average deposits rose 2% to $1.38 trillion. And while 2% is modest, the key here is stability. Despite all the movement of cash to higher-yielding accounts, the bank maintained a stable, massive base of deposits.
And that provides the crucial stability and liquidity for them to continue expanding lending activity.
Exactly, without having to resort to expensive wholesale funding.
Okay, capital ratios. These tell us about the bank's safety net. The Common Equity Tier 1, or CET1, ratio is the regulatory gold standard for bank safety. What was the outcome?
The CET1 ratio was reported at 10.6%. This compares the bank's core equity, the highest quality, loss-absorbing capital, against its risk-weighted assets. A higher number equals greater stability in a crisis.
Okay, I have to challenge you here a little bit. While 10.6% is well above the minimums, that number is actually down from 11.1% a year ago. In a world focused on bank stability, isn't a decline in your primary safety ratio a cause for concern?
That is a very fair challenge, but in this specific context, the decline is strategic and, you could argue, positive.
How so?
Well, a bank isn't supposed to be a savings vault that just hoards capital. A bank holding too much excess capital way above the regulatory requirement is actually considered inefficient. Every dollar held unnecessarily is a dollar they aren't deploying to generate profits.
Either through lending or returning capital to shareholders.
Precisely. So that decline from 11.1% to 10.6% signals an intentional optimization. It reflects the proactive deployment of that excess capital, primarily into those massive share buybacks we discussed, and into funding organic loan growth.
So they're moving from conservative capital hoarding to profit-maximizing deployment.
Exactly, while still maintaining a huge, robust buffer well above the regulatory minimums.
And what about their ability to handle a short-term liquidity crisis? The liquidity coverage ratio, or LCR.
The LCR was reported at 119%. The regulatory requirement is 100%, which means the bank must prove it can survive a severe 30-day market cash crunch. So WFC holds a substantial 19% buffer of high-quality liquid assets.
Yeah.
The fortress balance sheet is intact, robust, and now strategically deployed for growth.
The bank is generating capital faster than it needs for safety, compliance, or even organic growth, which brings us to the commitment to shareholders. And this is perhaps the largest single investment thesis for Wells Fargo right now.
This is the bank's ultimate commitment to its owners. In addition to the buybacks, WFC increased its dividend per common share by a healthy 13% during 2025.
A growing stream of passive income for shareholders.
Yes, but the true highlight, the sheer scale of the capital return, is that repurchase program.
The scale is just staggering.
It is. Q4 alone saw $5.0 billion bought back, retiring 58.2 million shares. But let's zoom out. The total figure for the full year 2025 is what speaks volumes.
For the full year 2025, Wells Fargo returned a massive $23 billion to shareholders. That's $18 billion in buybacks plus the dividend payments.
That confirms Wells Fargo is one of the most aggressive cannibals of its own shares on the market. This consistent, massive capital return provides an essential structural floor for the stock price. And more importantly, it ensures that EPS growth will continue to mechanically and materially outpace net income growth for the foreseeable future.
Management is signaling that capital return is a primary strategy now that the asset cap, the ultimate constraint on capital deployment, is gone.
It's a new era.
Moving to slide 5. The road ahead management's outlook and key takeaways.
We've now constructed a detailed picture of the bank's operational health in Q4. This final section shifts our focus from the backward-looking data to the forward narrative, using management commentary to project the bank's strategic trajectory into 2026.
CEO Charlie Scharf's comments during the earnings call, they really mark a definitive, symbolic shift. He's framing these results as a strategic pivot point for the entire institution.
His language was unambiguous. He explicitly framed the strong financial performance around the regulatory breakthrough. He said, "Strong financial performance coupled with the removal of the asset cap imposed by the Federal Reserve make me proud."
He is telling the world that the remediation chapter is closed and the growth chapter has begun.
He is. And that strategic freedom immediately translates into a new competitive posture. Scharf emphasized that WFC is now able to compete on a level playing field and dedicate resources to pure growth with the ability to grow our balance sheet.
So that confirms that the 8% asset growth we saw in Q4 is not a fluke. It's the intended, sustained direction of travel.
Right. This allows WFC to fully service large corporate clients that they couldn't even touch previously because of the cap.
He also very deliberately linked the cost discipline of the past to the opportunity of the future. The cuts aren't just savings, they are the investment budget.
Exactly. He noted that the fierce cost-cutting, those $15 billion in gross expense reductions, have not just reduced the expense base, they have funded new strategic investments in technology, in digital channels, and targeted growth strategies, all while lowering the overall cost structure.
That's the definition of powerful management leverage.
It is, and it led him to express explicit confidence in the momentum we have going into 2026.
Okay, let's synthesize everything we've covered into 4 core takeaways for the learner who needs to quickly grasp the Wells Fargo story right now.
The first and most important takeaway is the structural change. The asset cap era is officially over. The evidence is clear in the 8% growth in total assets and that robust 12% growth in commercial loans. Wells Fargo is fundamentally a different growth-seeking enterprise than it was a year ago. This is the biggest long-term change in the WFC narrative.
Second, we have that defining tension of the quarter. Profitability beats revenue for now. They had the $1.76 adjusted EPS beat, but the top-line revenue miss still spooked the market.
And that tension is defined by the bank's excellence in cost control. Their 64% efficiency ratio proves they are masters of expense management. They are crushing the bottom line by controlling what they can, however.
The revenue miss reminds us they are still susceptible to macro headwinds.
Exactly, be it lower loan demand or that constant margin compression from deposit mix changes.
The third takeaway is the segment divergence, that K-shaped recovery we detailed in slide 3.
The growth stars are clear. Wealth management, up 10% on revenue, benefits directly from market appreciation. And the core consumer banking segment, up 7%, is highly profitable due to fierce cost cuts and confident consumer spending.
These segments are accelerating.
And they are compensating for the laggards, commercial banking and home lending, which are just fighting the current interest rate environment.
And finally, the fourth takeaway relates to immediate shareholder value and the future mechanism for EPS growth, the buyback machine.
The $23 billion returned to shareholders in 2025 is not a one-off event. This commitment ensures a significant, persistent floor for the stock price. It also guarantees, mathematically, that the EPS growth rate will continue to materially outpace net income growth well into the future. It's a powerful tailwind.
So what does this all mean when we connect the dots? The narrative is shifting from a story of regulatory constraint and compliance remediation to one of normalized, capital-generative growth.
And the operational discipline they were forced to learn during those restricted years, that fierce cost cutting that generated $15 billion in structural savings, is now their greatest asset.
Right.
That discipline is being applied just as the ultimate strategic handbrake, the asset cap, has been removed. The cost cutting isn't just saving money, it is actively funding the future expansion and growth strategies that the cap now allows.
And when you assess that immediate negative market reaction, that 5.32% drop, it really appears to have been an emotional reaction to a temporary revenue shortfall.
It seems like it was potentially overlooking the fundamental structural shift in the bank's operational freedom and its vastly improved efficiency profile.
This report truly signals the definitive close of the constrained chapter and the open of a powerful new execution chapter for Wells Fargo.
It's a new WFC.
That brings us to our final provocative thought for the listener.
We spent a lot of time discussing the aggressive capital return program, that $23 billion deployed in 2025 to buy back shares and pay dividends. It's a massive commitment. The provocative thought for you to consider is the long-term trade-off this implies. Is this aggressive capital return a sign that management genuinely believes their stock remains fundamentally undervalued, offering a better, safer return than investing in highly speculative organic growth opportunities?
Ooh.
Or, conversely, does this extraordinary level of buyback activity suggest that management is implicitly signaling that truly compelling organic growth opportunities, projects, acquisitions, market expansions, are limited in the current environment, forcing them to rely heavily on financial engineering to hit those high EPS growth targets?
That's the question you need to mull over as you assess the bank's path into 2026 and beyond. Thank you for joining us for this deep dive into the Wells Fargo Q4 2025 earnings report. Before we sign off, a few important disclaimers. This report is for informational purposes only and does not constitute financial, investment, legal, or tax advice. The information contained herein is not a recommendation or solicitation to buy, sell, or hold any securities. All investment decisions should be made based on your own research and in consultation with a qualified financial professional. Furthermore, this report was generated by an artificial intelligence model. Although the AI is designed to adhere to strict data sourcing and verification protocols, errors or omissions may still occur. All information, including financial data and calculations, should be independently verified by the user before making any decisions. Like and subscribe to stockanalytics.ai YouTube channel. Unfortunately, we have been demonetized from YouTube, so we've now shipped off to our stockanalytics.ai website. For $5 a month, users will get exclusive access to the S&P 500 and NASDAQ 100 libraries, as well as video requests.